Hello, everyone. Thank you for joining us today. I see that we have attendees logging on, so we'll get started in just a few minutes. I do want to go over a few housekeeping. We will be using the Q&A feature for the webinar today. There's also the chat feature, though we're not going to really be using that for Q&A, but if you know people on the webinar and you want to converse with them, please do. We do have a couple of polls that we'll be using through the webinar, so keep an eye out for those. It's 12 o'clock right now, so we'll wait just a minute or two and then we'll get started. I'll go ahead and take this opportunity to introduce you to our speakers today. Rob Cook is with us from CAPTRUST, and Kimberly Gambrall is with us from Downey Brand. All right, Rob, do you want to go ahead and take it away?
All right, I guess I'll get us started. First and foremost, thank you to everybody who is joining us, wherever you're coming from. We appreciate your time. We know time is one of our most valuable assets, and so the fact that you've taken some time to spend with us, we very much appreciate it. And we hope that this is a good investment of your time today. We thought we'd just start by giving you the lay of the land, what we're going to talk about today. We're going to do some very quick introductions so you can get to know Kimberly and I a little bit more, why it is that we're up here in front of you, why we're talking to you. And then I'm going to be covering points 2 through 4, Kimberly points 5 through 6, and then we're hoping to leave about 15 to 20 minutes for questions at the very end of both of our presentations. So you should expect us to be up here talking for about 40-45 minutes. Please, by all means, interject whenever you have any questions. Mary will be paying attention to the polls and to the Q&A so that we can get that feedback from you all. We would love to make this far more interactive, hence why we've created a couple polls and different things. So by all means, please interject whenever you'd like. We'd love to get questions from you and hear your thoughts and comments as we're going. So with that, I'll take a moment just to introduce myself. My name is Rob Cook. This is me with my family. I am a CPA and a certified financial planner. I work for CAPTRUST, the largest registered investment advisory firm here in the country, United States. We're independent fiduciaries, and I love what I do, but this is not what I've always done. I actually started off working in public accounting at Ernst & Young, one of the largest multinational accounting firms in the world. I did everything from audits of large public companies and small private companies to tax returns for small mom and pop business owners up to multinational CEOs and actually some world-class athletes, which was really fun. But at the end of the day, I love being able to help people plan the future, to create something that's meaningful and to create a legacy for them and their families. And so because of that, I took the opportunity to step back away from public accounting and move into wealth management, where I moved from reporting on the past to planning the future. And that's what I do now. My family, I'm born and raised in the Sacramento area. Most of my family is from the Loomis area. So ag and the ag culture is something that's been part of my family and my blood for a long, long time. Though I'll admit I did not grow up on a farm, but it is something that I got my hands dirty all the time, helping my grandfather on his property and my cousins on theirs. And with that, I will turn it over to Kim to introduce herself as well.
Hi, I'm Kim Gambrall. I'm an associate attorney at Downey Brand. I work in the firm's corporate and real estate practice group. I focus on real estate transactions. That being said, I come from a farming family background. My family farms almonds and peaches in California's Central Valley. And so I grew up in the agricultural industry, and now I bring that background into my legal practice, which is why I'm here today to talk about agricultural leases. So thank you for having me and welcome to our webinar.
All right, and so with that, let's just jump in. As Kimberly and I were thinking about how to structure this webinar and what might potentially be most valuable for listeners of this webinar, we thought that it might be important to step back to see the bigger picture initially. Agricultural leases are a great potential opportunity within the ag space, but we need to understand their context both within real estate and then also within the broader perspective of your overall investments and how you view your portfolio. So we wanted to start off with a quick poll, and that is this: what does your portfolio consist of? When you think of your investment portfolio, what's there? What comes top of mind? And I think Mary has a poll here that she's starting. There we go. Thank you, Mary. You can choose as many as you'd like here, but we'd love to know, what are your thoughts? What is in your portfolio? Is it stocks, bonds, maybe mutual funds, ETFs, maybe a little private equity or hedge funds, because maybe you have an advisor that gives you access to those things, or perhaps you're connected into that space, or is it something else altogether? When you think of what is your portfolio, we'd love to know kind of what your thoughts are there. So we'll give it a minute or two here for you guys to respond as much as you'd like. And then we will continue moving along. It's funny, and oh, okay, I think, all right. All right, so we got 83% with stocks, 42% bonds, 67% mutual funds, ETFs. Ooh, we got a little bit of private equity, great. And then other, okay, well, I'd love to know what consists of that other, and I think we'll have opportunities to kind of talk about that as well as we continue to move forward. And I'm glad that there is a chunk there that has other, because honestly, as I think about, what is in a portfolio, there should be more. There are other things that you need to account for as you're thinking of your overall investment mix, as you're thinking of how do I manage the risk, the financial risk to me and my family, as when we think of our long-term finances. So thank you so much for taking the time. Some other things that might be in that other could be things like real estate, like we're going to talk about today, whether we're talking agricultural real estate in any particular way, or everything from single family homes to office space. They could be collectibles, coins, art, private investments, syndications, and a host of other things. So every single one of these individual other asset classes that are part of your portfolio could very easily be their own webinar in and of themselves. So if you do have those things, as always, please make sure you get good advice, good competent advice from professionals who are familiar with the space. And we hope that today we can show you, showcase a little bit of our understanding and our ability to perhaps be of value to you all as you are thinking of investing in land, and specifically these agricultural leases. I think at this time, Mary, you had mentioned, I think you made a note that there was a question coming in the Q&A.
I did have, thank you, Rob. Yeah, a question came in. It says, why should we be thinking about these other asset classes when thinking about our portfolios?
That is a great question. Honestly, that's a wonderful question. And actually, it leads right into my next slide. And what it really comes down to is you're only seeing part of the picture. This here's a picture of the Titanic. I think most of us are familiar with the story of the Titanic. April 1912, the Titanic leaves from England on its maiden voyage across the Atlantic to the United States. About 2/3, 3/4 of the way there, it hits an iceberg, and what was thought to be the unsinkable ship is now sunk and sits on the bottom of the Atlantic Ocean. And why was the Titanic sunk? Well, first and foremost, because they couldn't see what they couldn't see, which was the iceberg under the water. We've all seen pictures of icebergs, right? Only a very small portion of it is actually above the water. The largest chunk of it is below the water, and it ripped a hole in the side of the ship. And I think the second factor that contributed to its sinking, and granted, I'm no historian, there's lots of theories out there, but the other one I think is in part pride, right? The captain and the crew and those who designed the ship thought it was unsinkable. And that's why it was called the unsinkable ship. And I think us as investors, as people in general, that's a normal thing. We think we're unsinkable. We think that nothing could go wrong. But at the end of the day, if we don't take proper precautions to consider all things, we can very easily be sunk by something that we just don't even know is sitting there right underneath the water. And so once again, we hope that today this webinar is valuable for you, to help you perhaps see things that you haven't seen, and to perhaps help you know when it might be valuable to have someone like Kimberly or myself helping you think through some of those things that you might not see. I think I see another Q&A up there. Mary, is that another question that we wanted to perhaps field this time? Let's see here. Oh, it's that question. Okay, never mind. And we'll keep moving. Okay, so now that we've kind of talked about overall portfolio, let's talk about real estate within the portfolio. Why do we need to consider real estate in the context of our portfolios, and how do we understand what's happening with what's going on in the real estate market? And I think the best way to understand what's been happening overall in the what we call alternative asset space, that's your real estate, your collectibles, your coins, all those other things that we're talking about in this alternative space over the last few decades. This here is a chart that shows the 10-year treasury yield. The 10-year treasury is considered your risk-free asset in the finance world. It's the asset that kind of becomes the benchmark for so many other things. And 40 years ago, you could get double-digit returns without taking any risk. If you look there, late 1970s, we had the high inflation of the late 1970s, and so the Federal Reserve jacked up the interest rates in order to squash potential inflation. Well, inflation we were already having to squash it. And what it did is it gave us risk-free returns in double digits. People could go and get a CD for high single digits. You could buy a treasury that give you 12% guaranteed for 10 years. Why would you invest in riskier assets if you could do that? So naturally, investors did that. They flocked to those things. But over time, the last 40 years, interest rates have continued to drop. And with every drop in interest rates, investors who were previously in, quote, risk-free assets like a 10-year treasury note or say a CD or something like that, or just sitting in your bank, they have been forced to move to riskier asset classes in order to achieve the same level of returns that they had before. So investors who were in CDs are now in short-term bonds. Investors in short-term bonds suddenly became high-yield bonds. High-yield bonds became value stocks. Value stocks became growth stocks. Growth stocks became SPACs. SPACs became crypto. Crypto became NFTs. And the story continues to go on. Everyone has effectively been shifted up the scale of risk as time has gone by because interest rates continue to drop. And we're continuing to strive to get good returns so that we can beat inflation and those other factors that impact our overall portfolios. But because of this, what this has also done is it has led to increasing real estate prices, because we know interest rates are deeply connected into real estate, and it has caused many investors to step outside of what would have been, quote, traditional asset classes, stocks, bonds, mutual funds, ETFs, and move into these alternative asset classes like real estate. That's why you see institutional money like BlackRock going around and buying thousands of single-family homes in the area. In fact, I had a conversation just a couple months ago with a realtor here in Sacramento where she had a representative from an institutional money lender, might be the best way to describe it, or money institution, where he had bought 6 homes sight unseen that day. And that's just purely because there is more cash. You're not getting anything for your cash. It's just sitting in the bank or sitting in these risk-free assets. And so large institutions are being forced to go and find more returns. But this is happening across the board. And this is in part what's led to this increase in real estate. And one of the reasons why it's more important for us to consider and understand the factors impacting real estate long-term. So with that, I did want to throw out a poll here really quick at this point, which is just how many of you are already investing in real estate? I know that we have a few of us that may have already been doing that and some may not, but what I cover here in the next couple of slides, knowing how many of you are actually invested in real estate will help me know how in depth I probably should be talking here. Because if you're already very familiar with this space, I don't want to cover stuff that you all already know. So we'll take a second here, perhaps answer that poll, and we'll keep going. Okay, 82% of you are already invested in real estate. That's great. Only a few of you here are not invested in real estate at this time. So what I'll do is I'll move pretty quickly, but for those of you who may not have already been invested in real estate, if you have any questions on anything I touch base on, please feel free to drop a question in, reach out to me personally after this. We'd love to talk shop. Real estate's a great asset class. So let's just talk real estate really fast. Real estate's appeal. Real estate has a lot of different things that can be appealing. Here's 4 that come up really, really quickly. Cash flow, cash flow, cash flow. Anyone who's read Robert Kiyosaki's Rich Dad Poor Dad knows that for cash flow investors, real estate is the end all be all a lot of times, it feels like. Historically low volatility, but they also have equity buildup that you wouldn't get in bonds. You get the cash flow like a bond, but you get equity buildup like you would in a value stock, which makes real estate really pretty valuable. And at times even growth stock type potential. It's a great inflation hedge. It's a physical asset. People like the fact that you can touch and feel real estate. So a lot of times that's one of the reasons what drives them to invest in it as well. There are some tax benefits and a bunch of other things as well, but these are just 4 that came really, really quick. Drawbacks, lack of liquidity anyone who's bought any sort of real estate knows that it's a process. You can't just buy and sell it, just like you can if you go to your brokerage account with a stock or a bond. It takes some time. Longer holding periods, we'll actually talk about that a little bit here as it pertains to ag leases. Ag leases has some incredibly long holding periods, and you have to be willing to take on the risk for that extended period of time. High taxes at liquidation. This is a reason why you see the infamous 1031 exchange. For those who may not be familiar with that, it's a tax code provision that allows real estate investors to be able to effectively trade properties across and avoid taxes in that time. However, if you don't do a 1031 on a sale and repurchase of an additional asset, effectively exchange, you can have depreciation recapture, you have capital gains, you have a host of other things that can lead to actually a lot larger tax bite than most investors are wanting to get hit with, which is completely understandable. And then lastly, management. When it comes to real estate, unlike a stock and bond, you can let it just sit there in your account and let it grow, or drop and rise over time. You have to manage it. Even if you have a manager, you have to manage the manager. That's just what comes with that. Another thing here, I just quickly want to touch base on. When it comes to real estate, I think it's really funny that people consider physical assets like real estate only a physical asset, when in all reality, in today's world, everything is a paper asset. Everything is a 1 and 0, and even a property like an apartment building or an ag lease, there is a piece of paper that dictates that investment. Everything is a paper asset. It's really funny, and I sometimes have these conversations with, well, it's a physical asset, that's why it's so great. So, okay, that's true, it's great, but it still comes down to paper. It's just something I throw out there. Okay, so within real estate, we've talked general big picture in terms of why to consider real estate. How does real estate generally fit in what's happening in our overall markets? Now we're going to do a quick dive into land. So when we talk about land is, in my opinion, one of the most misunderstood real estate asset classes. And I think that's for a host of different reasons. But there are some important things to consider when you're going to invest in land. I think the first is that one of the benefits is that there's no toilets, tenants, and trash. Anyone who invests in real estate, like most of you all know, hey, toilets, tenants, and trash is the bane of the existence of most real estate investors who have any sort of property. You might have a tenant if we're doing this ag lease investment. You can have a tenant for sure, but generally speaking, you don't necessarily have a tenant when you're investing in land, and usually it's a far simpler situation than if you have someone living in a home, a single family home, for example, if you've purchased one of those. The long-term returns on land are actually incredible. They have volatility of those 10-year treasuries like we're talking about before, meaning they don't fluctuate hardly at all, which is great for the overall diversification of a portfolio as you're thinking of your overall investment, the health of your overall family finances. But it does have great long-term potential, far exceeding a lot of times bonds and even some value stocks, depending on what you're doing with your land. And another reason why people say, oh, you can't invest in land is because it doesn't cash flow. And that's simply not true. That just comes down to lack of exposure to the asset class. And there's a host of various ways in which you can get cash flowing opportunities from land. And today we clearly are going to cover one of those. Lastly, it's also good to know, land has a lot of different uses. Today we talk about leases, but there's storage, there's farming, there's grazing, there's construction, there's all sorts of different things that you can use your land for, and that have the opportunity for great returns and to be a great investment. Mary, I see we had another question come up in the Q&A. Did we want to?
We do, Rob. It's can you give us an example of how you've seen people use land outside of agricultural leases for cash flowing investments?
Yeah, great question. Like I mentioned, there's a host of different ways. One, let's just take storage here, very top. I have a friend who purchased land outside of Lincoln, California. If you all know where Lincoln is, kind of northeast of Sacramento. And out there was not much going on. But come to find out, there was an S&P 500 company who was investing in some infrastructure and needed some space for both their equipment and for some of their vehicles. And his land was open, and it looked like a good spot for them to put all their vehicles. So they approached him and said, hey, we'll pay X amount every single month if you'll just put up a chain link fence, and we'll handle all the in and out. We'll keep security there. We'll lock it up. You don't have to do anything except for just let us use your land. He said, sure, let's do that. So now he has a monthly payment coming in from a very secure tenant who, cash flow is very, very consistent. So that's just one simple example of how you can cash flow land. Great question. Okay. When it comes to land is part of the reason why I think land is misunderstood is because land has a lot of unique pieces to the due diligence equation that you need to consider. And there's a host of different things. In fact, I just listed off a bunch of them here, depending on what you're trying to do investing in land. There's a bunch of different things that you might want to consider as you're potentially going to purchase a piece of land. And some of these you can clearly figure out yourself, like feasibility of intended use. If you have a piece of land that's got a slope like this, it wouldn't make any sense to try and build a house on it, right? It might not even be possible. Or if you want to buy some land to have an agricultural lease there, if the land isn't tillable, if it's sitting on a swamp, well, clearly you can't use it for its intended use. But there are other issues where it might be valuable to have a professional like, say, Kimberly come along. We're looking at title issues, or maybe zoning or HOA restrictions, or if you already have a tenant on the property with a lease already established, it would be wise to bring her on before you make the investment. There's all sorts of different things that are very specific to investing in land that are important for investors to consider as they're making that investment. With that, I think it's time to turn the time over to my co-host here, Kimberly.
Hi. So you are at the point where you've had your discussions with Rob and you've secured a piece of agricultural land and you've done your due diligence and you don't know what's next. This is where I would like to propose an interesting and potentially valuable strategy for managing your land, and that would be through an agricultural lease. So I'm going to talk today about agricultural leases, and they're a very unique type of lease. But before we dive into all the details, I do want to take a moment and just note that there are a variety of contexts in which the agricultural lease can be used as a valuable tool, not just in the context of holding land for investment purposes where maybe you're not a farmer, but you want to, bring the agricultural land to its highest and best use, so you bring in a tenant. That's one noted example. I have a few other up on the screen right now, but these are by no means an exhaustive list. But just to give you a picture of other contexts where an agricultural lease could be a great tool. Maybe you're here today because you have been or are going to be on the tenant side of an agricultural lease. And I just want to let you know we do represent both sides. So maybe it's in the context of the way the business is structured, in that you have a partnership formed to own land, you have an LLC formed that is going to be the operating farming entity. And technically it's the same principal parties under each, but there is a lease arrangement between the two. That's one example. Or, you're a farmer, you've farmed an orchard your entire life, and you've been farming your entire life. You have a particular orchard that still has a lot of life and value left in it, but you're kind of done. So you bring in another farmer, maybe your neighbor, to lease that land from you. And so you get to sit back and take your retirement. So there are different contexts where they can be a very valuable tool. Today, we are going to talk more about an investment, a means of investment. And so it's going to be slightly landlord leaning. So there are different types of agricultural leases, and today we're not going to focus too much on grazing or annual crops. Grazing leases are sort of what they sound like. It's when cattle is grazing on your land, and you, or if you own the land, you permit that under the lease. Annual crops are crops that have a one-year life cycle. Such as corn, where it's planted in the spring, it grows, it's harvested in the fall, and then you rip it out and prepare the land to start all over again. And annual crop leases will have very similar terms and overlap with perennial crop leases, which we're going to get into, but they typically have shorter terms. And so that's why I'm not speaking to those mostly today, because if we're looking at land as an investment, we are going to be looking at an agricultural lease for a crop that's going to be there for quite some time, which brings me to the focus of today's agricultural lease seminar in perennial crop leases, which tend to be long-term leases. So a perennial crop is a crop that does not need to be replanted each year. They are typically orchards, almonds, grapes, walnuts, pistachios, fruit-bearing trees, and they are crops that are planted, and you put all your time into the development of the planting stage. They might have a few years of unproductivity, meaning they're not bearing fruit, but then come year 3 or 5, they are producing fruit, and they go through several economic cycles where they are producing fruit before they come to the end of their economic lifespan. Perennial crops are great for soil quality. They really reduce the need for a tenant to spend time and money and energy in developing the land each and every year to replant. So the hallmark of a perennial crop lease is that the term is considered a long-term lease, which is kind of a niche, nuanced term. And the term is tied to the economic life of the crop. Do we have a question, Mary?
We do. What does economic life mean?
Oh, that's a great question. The economic life refers to how long the crop is productive and profitable. So these perennial crops, like I said, can last for years and years and years. And so when determining the terms of these long-term leases, there's actually the University of California does a lot of the legwork for us in conducting studies and determining what's the economic lifespan, right? And just to give you an example, almonds have a current economic lifespan estimate from the UCC's cost studies of 25 years. Pistachios have a 40-year estimated economic lifespan. And so during that 40 years, the pistachios are producing nuts every year, and the farmer is able to make a profit off of those nuts. But at around the 40-year mark is when the cost to keep maintaining and caring and weed spraying and use pesticide, just really maintaining the crop becomes more expensive than the fruit production, like what's coming out and what you're getting a profit off of. That's when they consider the economic lifespan has ended. And that's when you rip out the crop and it's time to start something over. But you got a good 40 years for the example of pistachios. So, and that's a nuanced thing for these agricultural long-term leases. The other hallmark of these type of lease structure is the rent structure. And in the long-term leases, the rent is typically structured to be a percentage of the profits from the crop. And that's really where the value to the landlord is, because unlike in the commercial setting where you have a flat rent that's the same every month, you kind of have skin in the game, essentially, where if the tenant does well and the crop does well, then you're gonna stand to make some pretty good money. So a typical amount of percentage is probably about 15% is common, the percentage that you as a landlord would get out of the crop. And then we would typically advise landlords that this would be the percentage of the gross profits, since the tenant's net expenses can't be controlled. And then we'd also might factor in, there might be years where the yield is not, the crop yield is not great due to weather or water issues or what have you. They just don't have a great crop year. And so we might add kind of a hybrid where there is a sort of a base rent that the landlord is getting, so that they, have a safe harbor in the, event that the crop doesn't do well. But that's the two hallmarks of the long-term development leases. They have a long-term, and then you're kind of sharing in the rent as the landlord, which can create some issues, but we'll talk about those later.
Excuse me, Kim, we did get another question. Somebody was interested in the water supply reliability in land cost and ability to get high quality long-term leases.
Can you say that again? The water quality cost?
Yeah, talk about the water supply reliability in land cost and ability to get high quality long-term leases.
Okay, so I think I understand. And I do have a slide later on talking about water. Do you want me to wait and address this question then and fit it in there?
Yeah, let's go ahead and do that.
Okay. So yeah, I do have a slide at the end for water. So just going back to this, I wanted to bring up some pros and cons for landlords and tenants in these leases. And these are just a few. For landlord, like I said, the high income opportunity because you're getting a percentage of the profits. It could have property tax advantages, particularly if the land is conserved already for agricultural use. The tenants are likely going to be more vested in caring for the land so that you get the most out of your the profits from the crops. The cons, it's tied up for the land is tied up for the life of the lease. And that basically means that it's going to be less marketable because you have this long-term lease in place. They also might not be able to take advantage of changes in crops like you could with an annual lease. You can change every year if the crop's not, you see that doesn't do well in the area, or, it's just not as profitable of a crop anymore. And that you cannot easily do in these type of leases. For tenants, the pro is they're not paying for the big ticket investment in the land. And that makes it really easy for a farmer to come in and just take the land and do what they do best, which is the farming aspect. The cons, they're not the landlord, so they're not gaining from the land value. And also it can be a big expense for the tenant to improve the property, especially with a long-term development lease where you're coming in and developing the property, adding irrigation or whatever you need to make sure the crop is viable. And taking that out at the end of the lease, if that's a requirement, can be expensive.
Kim, I did get another question if you have a chance. Dan said, you mentioned a 15% share rent. How do you derive that rent? And what about the time period to develop the orchard or the vineyard?
That's a good question. So the rent, the actual percentage is, I just said what we commonly see. We see a range of what's been negotiated, and that is usually not my part, right? I document everything, but the actual terms of rent is a negotiation between the landlord and the tenant. They can use different factors to determine that. And that's why I mentioned the UCCE cost studies, because those go through tons and tons of factors and studies that have just kind of the general what they're seeing for a particular crop, and can be helpful in determining what a good percentage of profits would be. But ultimately that's a negotiating factor between the parties. And then can you remind me the second part of the question?
It said, and what about the time period to develop the orchard or the vineyard?
Right. So the time period is going to be for development will be at the beginning of the lease. And that's a term that we could address where it depends. It's going to depend on the crop, right? What the tenant, and landlord work out. But let's just say they decide that 5 years is needed for, developing the land, planting it. And that's going to account for those years where let's say almond trees are not going to be producing nuts, or at least not any that makes a profit. Generally, we'd likely structure something where like I said, the landlord gets sort of a safe harbor payment during that time before the percentage profits kicks in. I think that answers the question. So I'm going to talk about some typical lease terms. And I want to say at the outset that this is mostly issue spotting because depends on the crop, the land, the parties. It could be a variety. The end lease result could look different in different contexts. But there are certain issues that I'd like to just make you aware of, or maybe you haven't thought of. And so we'll talk about those. At the outset, I want to make an important note that a lease, an agricultural lease, especially a long-term agricultural lease, should be in writing. And coming from a farming family and working on the farm, I know how a lot of deals are done. Sometimes it's just a handshake, or that's how it's always been, and we trust each other. But I am here to say that that's not the best. And actually, and like, you may think it's more contentious to have something all official in writing, but it's actually better for both parties because all their expectations are in the lease document. And if any issue comes up, the goal of a good lease would be that if any issue comes up, either party can look to the lease agreement and know what they're obligated to do or what they're expected to work out between each other. So in California, in order to have a valid lease agreement, it needs to, at a minimum, contain a description of the property, a beginning and end date, so the term and the rent amount, and needs to be signed by both of the parties. And this goes for any amendment to the lease in the event that the parties make changes, and those should be documented in writing as well. I also wanted to bring up a few interesting California specific provisions. So the idea behind putting a lease in writing is that there are some default rules that are going to apply in the event they're not addressed in the lease, or in the event you don't have a lease in place. And some of those are interesting. Some of them are important for liability reasons. And one of these is the holdover tenancy, different from a commercial context where if a tenant stays past the end of their term, as in the term ended, they're supposed to either leave the property or negotiate to stay longer with the landlord. That defaults to a month-to-month rent situation. In agricultural leases, it's actually a year-to-year default situation. So if if you're the landlord and you didn't like the tenant and you wanted them out, it's important to not let this holdover tenancy turn into a year-to-year, where you have a whole year before they that you've essentially consented to them staying. Agricultural leases do have a term limit of 51 years, which is longer than what you typically see in commercial leases. And that doesn't mean that they have to be 51 years. It's just they shouldn't be longer than 51 years. And typically in these contexts, like I said, the pistachios is a 40-year lease. That's going to fall well within this range. The last interesting thing I wanted to touch on is, as we were talking about the profit, the landlord is sharing in the profits that the tenant receives from the sale of the crops, that can trigger a partnership issue that you'd want to address in the lease. If you do not intend to be in a farming partnership with the tenant, that should be made clear so that you aren't liable to tenant as their partner, essentially. And then also, kind of on the same thing, is this farm labor contractor liability issue, where California says that if a tenant farmer, or a farmer in general, is not adhering to California employment rules, not allowing their employees to have meal breaks and rest periods or whatever, not paying them appropriate overtime or whatever, and the farmer should be the one on the hook for that. California actually says that the landlord potentially could be on the hook. So that needs to be addressed in the lease to make sure that that sort of relationship isn't blurred. It has to, set aside the duties and obligations of each party. And then I have a list here of common terms. And again, it's mostly issue spotting for you to be aware of. And we already sort of talked about term and rent. The use of an agricultural lease is going to be the specific use for the development and farming operation and production of a specific crop. The landlord is likely going to want some standard of performance for the tenant farmer. Expenses, you're going to want to allocate who's paying for what under the lease. And, tenants are usually obligated to pay their crop development, farming expenses, and utilities. Landlord may be obligated to pay property taxes. And then indemnity is a big one, especially with hazardous substances, since farmers are using chemicals and pesticides, and the landlord is going to want some carve outs for the tenant's indemnity obligations there. And you may even consider putting putting that in as a default, since California has some strict rules on pesticide regulation, and as landlord, you'll want tenant to adhere to those. And then default, early termination. So these are pretty typical terms, and every lease is going to look different, what's negotiated, but I just want you to kind of just see things to be thinking about. And then I have a list of some other more in-depth issues that you may or may not have thought about, but are also important to address in the lease, because as I said earlier, the goal of the lease would be that any issue that comes up between the parties, you can look to the lease document and know, and that's the best way to preserve that relationship, since you're in it for 40 years, right? So some other issues, if you have a lender, so let's say this is the investment context, you've purchased this agricultural land and you actually have your mortgage on it, they may require subordination from the tenant. Or personal guarantees, maybe you want the tenant to give you personal guarantees for rent, given that, you know, especially if you're not a farmer yourself and you don't know what you're inspecting as far as the standards, and you want security to be paid your rent, you may consider asking tenant for personal guarantees, and those can be a variety of different things. The condition of the property at the end of the lease term can actually be a very contested issue between the landlord and the tenant. And so it's important to address it in the lease. And what I'm referring to is when you're doing these these long-term leases that start as crop development with the planting, maybe the tenant has come in and done irrigation lines, and they've just put a lot of money into developing the property. At the end of the lease term, who is going to be responsible for removing everything, and who is going to be paying for that? And so if this is addressed in the lease, there is going to be less problem at the end of the lease term. Another big issue is tenant contracts. And this especially comes up in the context of vineyards, where the tenant has a grape contract with the winery. And we've seen where wineries attempt to make the contract between them and the farmer run with the land. And you as landlord are going to, be wanting to look at those contracts that the tenant has to make sure you're comfortable with them. Sometimes they also, permit the tenant to change grape varieties or whatever. And so you as landlord need to make sure you've reviewed those and have identified in the lease, do you have permission to veto what tenant is doing with crop changes in that manner. Use of pesticides we touched on. And then I have a few here that kind of go together that ultimately I think the best idea is to include a map as an exhibit to the lease. And so when you're talking about, agricultural land it can have, a bunch of space where there are orchards, but then maybe there's a residence, and maybe you're going to live in that residence, but then not farm the orchards in front of it. Or maybe it's farm worker housing, or there are dirt roads connecting from main roads that go all, intertwined through the properties. And so all the rights that tenant has to the access the property, to use turnarounds or staging areas for harvest, whether the tenant is going to live in the residence or you're going to live in the residence, all of that needs to be spelled out in the lease so that everyone's aware of what rights they have and what rights they don't have. And I just think a map would be easiest to identify all of that. Another issue is noise, dust abatement issues or buffers. So sometimes the agricultural land may, abut right at the edge of town, and there's a school or a residential area, and maybe the county requires an agricultural buffer. Just being aware of those, and that's something that we could help you with is, if we're reviewing the property for you, we're going to pick out all those things and know what needs to be addressed. But it's just helpful for both parties to know what their duties are with respect to that. And then I have a couple hopefully fun ones. I'm not trying to bore you too much with all of the lease term details, but these are a couple issues that our firm has actually addressed. So what happens with the death of a tenant farmer? So you're in this 40-year term lease, you're in year 13 and the farmer passes away. What happens in that event? That's definitely something that could be addressed in the lease. That could look like a variety of different things. Maybe they already have someone who's, planning to step into succession that they can identify. Maybe the landlord wants to have some veto rights as far as who they're choosing, because the landlord's still invested at that point to get the most profit back from the crops that are farmed. So we want to have a good farmer, right? Put back to replace the tenant. Another issue is sampling of the fruit. So we had this come up in our firm as well with a lease where the landlord, it was an instance where the landlord lived on the property that was being leased to a farmer for farming grapes for a vineyard. And the landlord had this custom each year to host a big harvest party. And then all the landlord's friends would go out into the field and eat the grapes and pick the grapes and take them home. And it wasn't just, a few samples. It was many grapes that they were hauling off out of the vineyard. And this created a huge issue because for the tenant, that's their livelihood. That's what they're farming. They're doing it with the intent to make their profit, their money off of it. And so landlord felt, it's my land. You're my tenant anyway. And so it can create contentious things. And so I just thought that was kind of a fun example that you don't hear about. So finally, I am going to talk about water. Okay, there we go. So the water issues are huge in California, as we all know. And it's very important that the lease does address water issues. And this includes the water infrastructure. What's kind of the lay of the land? Do they have riparian wells with rights? Or are we working with an irrigation or a reclamation district? How, the water availability, where it's coming from, and then who's responsible for payment of the water. And that can be, who are we allocating the responsibility to pay assessments for the water, or who are we allocating responsibility to pay for the wells being repaired, and et cetera. So these all should be addressed in the lease. And it's fairly typical to have tenants pay for, the costs of installing irrigation and the cost of assessments. But there are some issues that, could be negotiated either way, where if there's a major well repair, the tenant's argument is going to be that the well is there and the landlord gets the benefit of the well long after the tenant. But the landlord's argument might be the tenant is the one getting all the value from the well. I'm not using the well, therefore they need to pay it. So the water issues there are many, but I just wanted to address them. They're definitely something that should be handled in the lease. And I wanted to make sure I covered that earlier question. Mary, if you don't mind reading that again, that was related to the water issues.
Yes, it said, can you please talk about water supply reliability in land cost and ability to get high quality long-term leases?
So water supply reliability. So my thought here is that definitely as a landlord, you aren't going to want to guarantee water supply availability because things are changing and you don't know. You can't necessarily guarantee water if the government makes rules where it's going to change. But as far as, if you're, and I might not, I hope I understand the question correct when I respond this way, but I'm thinking it's referring to how are you going to get a great tenant based on the water available on your land. And that, if you have a piece of land that doesn't have the water available for a tenant's needs, then maybe it's not the right tenant, or maybe that means the tenant is going to do more development on the land. But again, I'd fall back on if you're the landlord, you just don't guarantee the availability of the water. but lay out, you know, what does the tenant allowed to do? Are they allowed to do their own irrigation? Are they allowed to pull water from an irrigation district? We're going to, you know, look at what districts you might fall under as far as where that sort of water availability would come from. So I hope that answers the question. And that's the end of my presentation. So
Thank you,
any
Kim.
other
I
questions?
did have one more question that came in while you were speaking to that last slide. It said, should you address government water regulations in the lease, like the Sustainable Groundwater Management Act? And how would you recommend dealing with that?
Yes, my answer is yes, that is something that can be addressed, especially if you already know that what some of your duties might be with respect to this, with that one, the Sigma Act. But again, I think this would go back to my answer to the prior question, in that the landlord really doesn't want to guarantee the water rights. And so, because they could be changing, right? Especially with Sigma. So it's just important to address the issue, identify that in the lease, and allocate the risks, and just make everything clear, so all parties are on the same page of an understanding of what they have now and what they may or may not have when things change under different water regulations.
Thanks, Kim. I did get one more question from Dan. Where do you go to get the needed information to evaluate water supply? Who are the experts you need to go to?
That's a great question, even from just a due diligence perspective before you decide to purchase a piece of land.
So I do know there are some services out there that have the technology to sort of do like a title review from a water perspective. And I can send you at least one resource independently if you would like me to do that. But it's similar to doing title searches and whatnot that we would do for regular real estate. There are some services out there that do the same thing, but kind of investigate the water risk on the property for you. Mm-hmm.
That is it for questions so far. Do you guys have any further comments, Rob or Kim?
The only comment that I would make is that, you know, Kim's clearly shown her expertise around leases and things to consider as it pertains to making any sort of investments like that. And when I think of this from an investment perspective, investing in agricultural leases, if you're not familiar with the space, I always encourage you to seek competent legal advice, and to seek the advice of professionals who are familiar with the space, who can help you think through some of these additional issues that are unique to that specific asset class. Just like it comes with anything else. Before you invest in an apartment complex, find a mentor or find, you know, competent advice around purchasing that type of an asset. Similar type of thing here as it pertains to your agricultural leases.